The envelope sits on your kitchen counter for 3 days before you open it. You already know what it says. Your accountant told you over the phone, flat and apologetic. $22,000. Federal tax bill, due in 6 weeks. You're 29. You run a small HVAC repair company out of a used Ford van with your name stenciled on the side. Last year, you finally broke 6 figures in revenue. You thought that meant you'd made it. Instead, you're staring at a number that could wipe out your entire savings account in one transfer. You open the envelope, you read it twice. Then you sit down at the table and do something most people don't do when they're scared. You get curious. You start asking why. Not why is this happening to me? Why does the tax code work this way at all? You call your accountant back, and this time you don't just ask what you owe. You ask what you're missing. He mentions something in passing. Depreciation, real estate. He says it like it's obvious, like everyone already knows this. You don't. You write it down anyway. That night, you don't sleep. You're on your phone until 2 a.m., reading about a concept that sounds almost illegal but isn't. Buy a property, rent it out. The IRS lets you deduct a portion of that property's value every single year, even while it's making you money. On paper, you can show a loss. In your bank account, you can still be up thousands. It feels like a loophole built by people who already had money, for people who already had money. You don't have money. You have a van, a toolbox, and a tax bill. But you have something else too. You have 6 weeks to figure this out, and you've spent your whole life fixing things other people gave up on. You don't buy a house that year. You can't. What you do instead is smaller, and it changes everything. You find a duplex 2 towns over. Ugly place. Water-stained ceiling, a kitchen from 1987, a for sale sign leaning sideways in the yard. The bank wants 12% down. You have exactly that much sitting in the account you were about to hand over to the IRS. You do the math 40 different ways, then you do it again. If you live in one unit and rent the other, your mortgage lender treats it like a primary residence. Lower down payment requirements. Better rate. The tenant's rent covers most of your mortgage, and the whole property, even the half you're living in, starts depreciating on paper the moment you close. You sign the papers on a Tuesday. You move your mattress into the smaller unit that Friday. Your friends think you're insane. You went from a 2-bedroom apartment with a dishwasher to a unit with a stove that only lights on the 3rd try. Your girlfriend at the time doesn't understand why you downgrade your life to buy a leaking duplex. She leaves within the year. You don't blame her. You barely understand it yourself in the moments you let doubt in. But every month, the numbers get a little clearer. Your tenant's rent check covers 80% of the mortgage. Your HVAC business is still running. And when tax season comes back around, your accountant runs the depreciation schedule and looks up at you like you did something clever. You didn't owe $22,000 that year. You owed $411,000. That number rewires something in you. You stop looking at your paycheck the way you used to. You stop seeing taxes as something that just happens to you, like weather. You start seeing them as a system with rules. And rules can be learned, and once you learn them, they stop being your enemy. You spend the next 2 years reinvesting almost everything, not into things, into more roofs. The second property is a triplex near an old mill town that's starting to gentrify. You don't know that word yet, not really, but you can see it. New coffee shop on the corner. A brewery moving into a warehouse that used to make furniture. You buy before the town figures out what it's becoming. This time, you use something called a cost segregation study. Sounds complicated, isn't really. An engineer walks through the building and separates out everything that isn't the building itself. The carpet, the appliances, the parking lot, the fencing. Those things depreciate faster than the building does. 5 years instead of 27 and a half. The paper loss that year is enormous. Your HVAC business is now profitable enough that you'd owe real money to the IRS if nothing offset it. The properties offset it, legally, deliberately. You didn't hide a single dollar. You just knew where to put it. Your accountant starts calling you before you call him. By year 4, you're not fixing furnaces 5 days a week anymore. You've hired 2 techs and a dispatcher. The business still runs, still throws off cash, but it's no longer the whole story. It's become the engine that funds the buildings, and the buildings have quietly become the wealth. There's a moment around this time where you almost lose it all. The triplex needs a new roof all at once, no warning, $4,100 you weren't expecting. The same month, one of your tenants stops paying, and you have to start the eviction process, which costs money and takes months, and makes you question every decision that got you here. You lie awake doing math on your phone in the dark, wondering if you overextended. You don't panic sell. You've read enough by now to know that panic is expensive. Instead, you call your lender and ask about something called a HELOC, a line of credit against the equity you've built in the duplex, the one you no longer even live in because you've moved into a small rental nearby to free up that unit for another tenant. The equity is there because the depreciation lowered your taxable income for years, which meant more cash stayed in your accounts, which meant you paid down principal faster, which meant the bank now sees a property worth far more than you owe on it. It's not a coincidence. It's the same math, compounding in a direction most people never bother to look. You use the HELOC to cover the roof and carry you through the vacancy. 6 weeks later, a new tenant moves in at a higher rent than the last one. The math evens out. Then it tips positive. You realize something during those 6 weeks of sleepless math. The fear never fully goes away. You just get better at using it. By year 6, you own 4 properties, 14 units total. You've done your first 1,031 exchange, sold the triplex for a profit, rolled every dollar of that gain into a 12-unit apartment building without paying a cent of capital gains tax because the IRS lets you defer it as long as you keep reinvesting in real estate instead of pocketing the cash. Most people don't know this rule exists. You didn't either until you needed it. The HVAC business still exists, but you've mostly stepped back from the vans. You kept it because it taught you the reflex that started all of this, the refusal to accept a number just because someone official looking wrote it on a form. You still remember the exact weight of that first envelope, $22,000, sitting on your counter for 3 days. You keep a framed copy of it now, tucked in a drawer in your home office, in the house you finally bought for yourself 2 years ago. Not because you're bitter about it, because it's proof. Proof that the system nobody explains to you in school is learnable. Proof that the same rules that terrify people are just tools, waiting for someone patient enough to read the manual. Proof that the difference between the people who get crushed by the tax code and the people who build empires inside it usually isn't money. It's the 6 weeks you spend after the envelope arrives, deciding whether to get curious or get scared. You chose curious. You're still choosing it every single year, every single property, every single form. And the empire didn't start with a windfall, or an inheritance, or a lucky break. It started with a duplex nobody wanted, a mattress on a bare floor, and a decision to understand exactly why you owed what you owed, instead of just paying it and hoping next year would be different.